record. So we are in chapter 20, and chapter 20 is all about accounting changes and error corrections. But really, all right, what chapter 20 is mostly about is communication. What? Accounting is about communication? Yes, it is. And so that's really what we're going to be talking about for the most part, and having good communication. Right? And so I'm going to take my camera down, and I am going to share with you guys the PowerPoints. And we'll click this button. All right, so I think I can write on this a little bit better. And so as I said, chapter 20, it's funny because I actually had to look through the textbook. You know, it breaks it up into part A, all right, accounting changes. And then, through the PowerPoint, there is no part B. But in reality, part B is error corrections, all right? And so the types of things that we're gonna, really this illustration is a really solid overview of the whole chapter, all right? And so when it comes to accounting changes, there's basically three types, right? There's a change in accounting principle, there's a change in accounting estimate, and a change in reporting entity. And so roughly, they give a change in accounting principle. It could be changing from one generally accepted accounting principle to another, right? But it also could be because, the FASB or the SEC, or I don't know if you guys are familiar with the Public Company Accounting Oversight Board, right? But, they are now kind of set up by the SEC to help with formulating standards in accounting, right? But, if we changed, similar, if you remember when we talked about revenue recognition, they had made some changes on how we go about recognizing revenue. And that was, that's less than 5 years old, all right? So if we apply a new standard, all right, that's really what we're talking about here. So get a highlighter, adopting a new accounting standard. But really, it's a lot of times it's a change from one generally accepted accounting principle to the other, right? And they give you several different examples. Excuse me. Change in inventory costing, all right? So switching from FIFO to LIFO or FIFO to average, those are all generally accepted principles. Then they have a different, changing from the cost method to the equity method, for investments and things like that. Let me ask you, what about changing from the direct write-off method to the allowance for doubtful accounts? Do you guys think that that is a change in an accounting principle? And I'll give you a moment to answer as I drink a cup of coffee, or drink a swallow of coffee. With changing from the direct write-off method to the allowance for doubtful accounts, when it comes to bad debts, that's what we're talking about, bad debts. Would that be a change in accounting principles? Bueller?
I want to say yes, but I'm not, it's.
Well, I just actually stuck a granola bar bite in my mouth, so that's why I did not respond quicker. It is not a change in accounting principle. And the reason it's not a change in accounting principle, okay, is because it's changing from one generally accepted accounting principle to another, all right? If you remember, the direct write-off method is not GAAP. It is not a generally accepted accounting method, all right? A lot of people use it, right? They are allowed to use it because generally bad debt for some industries and stuff is relatively small, and therefore, because of the immateriality concept, they're allowed to do that, right? But it is not a generally accepted accounting principle. I can't remember if there was actually a quiz or a test question over that, but I remember that needing to be made clear. All right, so if you're changing from a non-GAAP to a GAAP principle or method, okay, that's actually an error correction. You've been recording that improperly in the past. Well, excuse me, I just took my last bite, so chewy, soft and chewy granola bars. But the big deal with these change in accounting principles, as you'll see, is that it has retroactive restatement. And can I just say that's a pain in the butt? All right. Basically, when we talk about retroactive, and we're going to talk more about it, retroactive restatement is that meaning that we have to go and for every financial statement that we're presenting, because again, this is, I said earlier, this is a lot about communication. This chapter is really about clear communication. Right? So when we do corporate annual reports or year-end financial statements, you generally show multiple periods. I think you show, I want to say you show minimum of 3 years on the income statement, and I think a minimum of 2 years on the balance sheet. You can show more, okay, but I think those are the minimals. Right? And so if you have a change in accounting principle, for every year that you show, okay, that you disclose and communicating, you need to use the same or the new accounting principle as if you've always been using it, right? That's, as I said, retroactive restatement. It's a pain, just so you know. That's really what makes this chapter somewhat difficult. It's not that hard, but, so. The next one, all right, we have is change in accounting estimate, all right? And so, throughout accounting, we have, so many different places that we utilize estimates. I mean, even talking about the allowance for doubtful accounts, we based that allowance or that expense, I should say, bad debt expense, on some sort of estimate. Depreciation, the calculations for straight line depreciation, 2 of the 3 numbers are just estimates. All right. And so throughout accounting, we use estimates a lot. And so when we get better information and we, newer information, we want to use that information. And so the most common example, and we have worked these, all right, was a change in, the depreciation. So we've been depreciating an asset, we had an estimated useful life of 15 years, okay. At year 10, we realize that, hey, this piece of equipment is going to last us a lot longer, right? We expect it will last an additional 10 years for a total of 20, all right? And so when we realize that, if you remember, we worked, I think, a homework problem in accounting 201, even going way that far back, all right? We took that new information and we just did prospective, all right, treatment of that. And prospective means the current period and moving forward. We don't have to go back and say, oh yeah, hey, now that we're smarter or we have a better idea of what's really going on, we have to correct those previous years. You do not have to do that. And so they give us a list of things here. And what's great about these is it's prospective, way easier. Then we have a change in reporting entity. All right, a change in reporting entity comes from one, one company buying a different company. All right, and so you might have had an investment. Okay, you're using the equity method. All right, but when you buy more of that subsidiary and you have more than 50%, don't forget we have to do consolidated financial statements. And so the idea is that for every year that we're disclosing in the financial statements of the parent company, right? So let's say we have a parent company, company A buys company B, right? company A's financial statements, they treat it as if they've owned company B, right, for all the years that are being presented in the comparative balance sheet and income statement. This, okay, is part B. All right, part B. Okay, even though it doesn't say it, all right. Error correction, okay. Correcting of an error caused by a transaction being recorded incorrectly or not at all, right? This could be mathematical, this could be, you know, you found that somebody had been embezzling and or fudging the numbers, all right? And so, you know, you need to retroactively change things, right? And so here's, you know, that example that an example, you know, where we have a change from the cash basis of accounting to the accrual basis, right? So, you know, the cash basis is not GAAP, right? We use accrual basis, right, for proper financial accounting purposes. And so, kind of going backward, reporting accounting changes and error correction, right? There's really only one thing that we treat prospectively, right, which is the easy one, right? All the others, okay, you know, so going back, whoa, kind of interesting, you know, so this is retroactive, this is retro, okay, and this is retro. Everything else is prospective, all right? So as I said earlier, retrospective approach, financial statements issued in previous years are revised. Okay? Statements are made to appear as if the newly adopted accounting method had been applied all along or that the error had never occurred, right? And then a journal entry is created to adjust all the account balances that are being affected, right? This, right, takes a lot of time and energy, right? Whereas if with a change in accounting estimate, right, we can just take that into the future. I do want to say that there is one change in accounting principle, okay, which you normally would record on retroactive, okay, that is actually handled prospectively. And it's kind of a funny story, all right? It's when we change depreciation methods, all right? So if you remember, I mean, most people, all right, use the straight line rate, okay? But there are other methods, you know, the double declining balance, some of the year's digits, units of production, right? And so, you know, you can change those or, you know, between those different methods, okay? And those are all generally accepted methods of depreciation. Well, what was funny is that change in estimates supersedes or overrules change in accounting principles. Or another way to say it, if you can change an estimate in one of those calculations, you don't have to do retroactive restatement. And so it became so commonplace that if there was a company that was going to change, let's say from the double declining balance method, all right, to straight line, okay, that they would actually, in that same year or same time period, they would say, oh, you know what, we're also going to say, instead of this being depreciated for 10 years, we're going to depreciate it for 11, all right? And so they would also change the estimates because the estimates would override the need for retroactive restatement. It would just be prospective, right? And so whenever you wanted to change from one generally accepted accounting principle in the treatment of depreciation, they would change one of the estimates, either the residual value or the expected life, so that they wouldn't have to do retroactive restatement. So that got to be such commonplace that finally the FASB said, okay, we get it. All right. We'll allow you, if you want to change from, you know, straight line to double declining balance method, will allow you, even though that is a change in accounting principle, will allow you to treat that as a prospective correction or change, I should say. So a change in accounting principle, right, as we said, from one generally accepted accounting principle to the other, through accounting choices, once made, should be consistently followed from year to year. Okay, by making changes, we want to show that consistency, at least for the years that we're presented. And so and that is why we want to do the retroactive restatement. And see, if you remember going back to our, what was it? The conceptual framework, all right? Remember, one of the goals of the conceptual framework was, and as far as communication, stuff like that, it was consistency, that we treat the same thing year to year to year, all right? And so when we have these change in accounting principles, we're basically breaking the consistency issue, all right? And so we want to make sure, okay, that somebody that has the current year's financial statements are comparing those numbers, okay? So let's say it's, we're showing 2018, 19, and 20's financials. That, and we're using, let's just say we were using LIFO, okay, for 2018 and 19, but we change in 2020 to FIFO. Well, if that's the case, all right, we need to restate 18 and 19 as if we've always been using FIFO, so that we have consistency in the current year's financial statements from the last, including the last two periods. Now, of course, with this whole chapter, there's going to be a buttload of note disclosure, right? Because if somebody had 2019's, year-end reports, those would have all been under LIFO. And so when they get 2020's and they're like, hey, wait, 2019's numbers have changed completely. Well, we need to be able to explain that, because, you would want to make sure that the numbers are the same from year to year, right? So I switched by hundreds of companies from FIFO to LIFO in the mid-70s. Reason because of inflation, right? And they wanted to do a better job of matching, right? There could also be changes within a specific industry or changes that might be mandated. And I brought this up, through FASB codification of the new standard, right? Or the implementation. All they're just saying is, hey, we got a new rule that we want you guys to follow, right? So from a decision maker's perspective, all right, the motivation for accounting choice, right, really it's how it impacts your financial statements. The effect of choices, all right, on management's compensation, on existing debt arrangements or agreements, and on union negotiations can affect management's selection of accounting method. Financial analysts must be aware that different accounting methods used by different firms and the same firm in different years complicate the comparisons, right? Because if you remember, why are we all following one set of rules, US GAAP? Why are we doing that? So that we can compare, right, one company to somebody else, right, or another company that's following those same rules. And so one of the reasons we have no disclosure of the main accounting methods we utilize, all right, so one company might be using FIFO when the other company is using LIFO. In times of inflation, which one of those companies, FIFO or LIFO, is going to have higher income? All things being equal. All right, so the only thing that is different between two firms is one firm is using FIFO and the other firm is using LIFO. Which one is going to have a higher net income during times of inflation? And I know I've asked this question way back in Accounting 201, I think. Remember the whole discussion about piles of manure and grain elevators and was it gas tanks? Right? Yeah, in times of inflation, using FIFO, right, is going to give you a higher net income. It's also going to give you a higher ending inventory than LIFO, right? And so, if you're trying to decide which company to invest into, right, you want to make sure that you're comparing apples with apples, right? That, hey, this company is using FIFO and this company is using FIFO for comparative purposes. Investors and creditors must consider not only the effect of comparability, but also the possible hidden motivations for making changes, right? So, again, this is from a decision maker's perspective or somebody considering investing into this stock. And so, we kind of want to know why are they making these changes? Is it mandated by the FASB? Well, then there's probably no malicious or financial manipulation going on. Right? But if it's just because, it's times of inflation and we want to look more profitable, and so we switch from LIFO to FIFO, well, you probably want to be able to discern that. So managers tend to prefer to report earnings that follow a regular, smooth trend from year to year. Okay, the desire to do this is not always in the direction of higher income, right? And so, they, I think I've drawn, graphs before, but most businesses want to have, their profitability going up something like this, right? Okay. They don't want to have it going like this, because the volatility, all right, can really scare people off. All right, we want to have a smooth earnings line if we possibly can, and so we can sometimes legally manipulate that to be more smooth. So the retroactive approach, all right, most changes in accounting principles, all right, and so that's my example earlier. It's most, all right, changes from one generally accepted accounting principle to a new generally accepted principle are handled retroactively, but not all. Most voluntary changes in accounting principles are reported retrospectively. Okay, and so here's an example. All right, Aero Parts Corporation uses the LIFO inventory cost method at the beginning of 2016. Aero Parts decides to change to FIFO. All right, and so I'm just trying to see if we can identify whether or not it's times of inflation, but generally it is. Okay. And so they give the income components of 2016 and prior years, all right, as follows. Okay. And so we made the change, okay, in 2000, at the beginning of 2016. Right? And so we're looking at the difference, right? What would have cost of goods sold been under LIFO? So this is when we changed to FIFO. Okay. And we had been using LIFO for these two periods. Right? And then there were all the years previous to that. Okay. And so you can see that we had a difference, okay, between in the cost of goods sold. And so this is times of inflation, right? Because we had a reduction in the cost of goods sold. Right? And a reduction in cost of goods sold would lead to an increase in gross profit. And if there's an increase in gross profit, there's going to be a related increase in net income. And so these were for the previous years. Okay, these are for the current period, okay, where we had the difference between LIFO and FIFO. Okay, it was 45, 55, and 60 in the current year. And they gave us the different revenues. It says Air Parts paid dividends of $40 million each year at the beginning of 2019 or 2009. Its income tax rate is 40%. Retained earnings on January 1st, 2014, right, or this year right here, was 700 million, and inventory was 500 million. And so, all right, when we revise the income statements, we're going to change things, right? And we're going to, so this is in the actual 2016's corporate annual report, okay? And so we show the 3 years, and we show it as if we've always been using FIFO and the ramifications that that's going to have on the net income. Air Parts makes the statement appear as if the newly adopted accounting method, FIFO, had been applied all along. And so the effects, right, of the switch to FIFO, okay, are going to have both balance sheet and income statement ramifications. And so a comparative balance sheet, right, then is going to report 2014 inventory at 345 million, higher than it was reported in last year's statements. Likewise, 2015 will increase by 40 million, and inventory for 2016 would be reported. This is the first time they're reporting it. Is 46 or 460 million, higher than it would have been if the switch to LIFO had not occurred. So again, hopefully you remember the flow of information. So because we're adjusting inventory, that's going to have a ramification on your cost of goods sold that has the inverse relationship on gross profit, which would, so increasing your gross profit by decreasing your cost of goods sold. That will lead to an increase in net income, right? Net income is closed retained earnings, right, which is on the balance sheet, right? And so we're going to increase retained earnings while we have also increased ending inventory, right, on the balance sheet. Yeah. So we increased it from here, right, to there. All right, I guess so that's not ending inventory, that's cost of goods sold. So that's not correct. Do I have an eraser? Eraser. But it has the ramifications of, in this case, actually going down. Okay, so we were using LIFO. We're now using FIFO. And so the impact, all right, on retained earnings. Okay, we started with January 2014. Okay. The net income is going to change, right? Because we changed 2014 net income. And then so the dividends stay the same. And so basically we're just showing the retained earnings statement for 3 periods, right? For the adjustment to the beginning, right? December 31st, 2014, 15, and then December 31st, 2016. So the pre-period, if you remember, we had a difference between FIFO and LIFO, right? Of that 400, that is going to be an adjustment to the beginning of retained earnings. And so we're going to increase, right, inventory. We're going to have the retained earnings, okay? And then we're also going to have income tax payable, right? Because if you have an increase in retained earnings, you're going to have to pay tax on that, and that's what this represents here, income tax payable. Note disclosure, as I said, it must be very descriptive, right? Because people who had the previous years, right, so we made the change in 2016, we'd report December 31st, 2016. If you own this company last year, right, 2015, when you looked at the 2015 financial statements that were issued in 2016, they're going to be different than what was issued in 2015. So you need to be, very descriptive. Along with that, you need to also justify the application for the new method, right? And know that it isn't, or it should not be, because we wanted to make our income look higher, because by making that change, if you remember, all right, we're really no better off or worse when we talk about the physical units that we had, because FIFO and LIFO and average are really cost flow assumptions. I bet that this company, even though they are, well, I guess they're switching to FIFO, right? But before, when they were using LIFO, I bet the physical flow, right, was actually first in, first out. Because most everything in this world moves that way, right? You want to sell the old computers with the old processors before you sell the new computers. You want to sell last year's cars before you sell this year's cars. You want to sell last week's milk before you sell this week. So most everything in this world operates under FIFO, physical flow. Okay? But because we can choose whichever method we want for accounting purposes, we probably say something, for this justification, we say this better aligns the physical flow of our inventory with our cost flow. We don't want to say, oh, hey, we wanted to do this because we wanted to make more, we wanted to report more money. Because actually this is a negative thing, because now we're having to pay more tax also. So yeah. Note disclosure must explain why the change was needed, as well as its effects on items not reported on the face of the financial statements. Point out that comparative information has been revised. Report any per share amounts affected, right, for the current period and all prior periods presented. Right? So the earnings per share that we had done last chapter. So here's an example, right? Disclosure of change in inventory methods for Abercrombie Finch, okay? And, in reading it, the company elected to change its method, right, for inventory from the lower cost or market, utilizing the retail method to the weighted average cost method, effective, blah, blah, blah. In accordance with generally accepted accounting principles, all periods have been, retroactively adjusted. Right, I'm looking for the rationale. Yeah, so it is preferable as it better aligns the company's focus on realized selling margins, improves the comparability of the company's financial statement results with those of its competitors, right? And so that is their rationale. Not, oh, hey, we wanted to, report more income. So the prospective approach, when retrospective application is impractical, all right? And so, this is when we have an accounting change, all right? But it's just too hard to do retroactive, right? Now, don't just say, oh yeah, they're all too hard, so we're gonna do prospectively, all right? There's just a select few things, all right? And so, this one is a change to LIFO. So if you remember the LIFO method, as long as we purchased more inventory than the last layer, as long as we purchase more inventory before we dip into the previous layer under LIFO, we will continue to add these things called inventory layers, right? And so to recreate all those inventory layers, is deemed to be impractical, right? And really not have that much, informational basis. And so with changing from any other method to LIFO, okay, we are allowed to just have prospective treatment. Right? We do not have to do retroactive. And so that's what that note describes that. The prospective approach, when retrospective application is impractical, right? Impracticability to determine some period-specific effect, right? The change is applied retrospectively, right? Where it's impractical to determine, right, the cumulative effect, right? That's where we're going to do the prospective. And we're going to start at the beginning of the earliest year of practice. The prospective approach, when mandated by an authoritative accounting literature. And so again, Sometimes, right, when the FASB or the Public Company Accounting Oversight Board come out with a new rule, okay, they actually could potentially say, hey, you know what? You don't need to do retroactive restatement. You need to do just prospective, right? And so let's just say they made the change in 2019, all right? Do we still need to have note disclosure? The answer is yes, right? Because there could be a huge impact, right, especially on the income statement because of that change. And so it could make us look either better or worse, okay, than we were last year. But really, the only reason that we look better or worse was because of this new mandated accounting rule, all right? And so, again, we definitely want to have full disclosure. And so they give an example here for a change from the equity method to another method of accounting for long-term investments. GAAP requires this prospective application of the new method. You don't have to go back. Also, as I mentioned earlier, the changing in depreciation, amortization, or depletion methods, right? Because of not the abuse, right, but just because the rationale, they're like, yeah. Changing from straight line to the double declining balance, yes, that is a change in accounting principle, but we're going to allow you to do prospective treatment of that. And I talked enough about that. Then change in accounting estimate, all right, this one we don't even have to worry about. It's just prospective, right? Thank God. Disclosure note should describe the effect of the change in the estimate on the income from continuing operations, net income, and related per share amounts, right, for the current period. So why all of a sudden, all right, are you incurring losses where in the past you were incurring, having net income, right? Well, because we changed some of our estimates. And so here's just an example of Owens Corning fiberglass. And it's kind of interesting. Yeah, so they give kind of the rationale for that change, and they show the effects. Okay, and take note that they, the effect of this change, all right, on depreciation expense for the year ended, all right, and then it also shows the cumulative effect. Right? So they show the specific change, okay, here. Okay, then they show the cumulative effect, okay, and they show, okay, the new earnings per share, or the effect by per share basis. So here is a change in accounting estimate. All right, Universal Semiconductors estimates warranty expense as of 2% of sales. Okay. After reviewing, or after a review during 2016, Universal determines that, hey, 2% was too low. We need to change it to 3% of sales, right, of its payment. Whatever. And so sales in 2016 are 300 million. The effect, the tax effect is 40%. And so no account balances are adjusted. The cumulative, because this was a change in accounting estimate, so it's only prospective, right? The cumulative effect on the estimate change is not reported in current income, right? We just do the calculation as if we always use 3%. So yeah, in 2016 and later years, the adjusting entry recorded warranty expense simply will reflect the new percentage. Okay. I'm thinking that they're talking about the tax effect, right? So the after-tax effect of the change is estimated to be, 1.8 million. Okay. Because they're subtracting the tax ramifications, and then they calculate the new, or the impact on earnings per share. The effective change was to decrease earnings per share by 18 cents. And so, has depreciation, all right, because we, what is this? Oh, yeah, just the sum of the year's digits. Yeah, hey, you guys remember how to do the sum of the year's digits? All right. So Universal Semiconductor switches from the sum of the year's digits depreciation to the straight line. Okay. So this is a change in accounting method. However, we're just going to do prospectively. Right? And so we made some changes here. All right. So the change affects the precision equipment purchase at the beginning of 2014 at a cost of $63 million. The machinery had expected useful life of 5 years and an estimated residual value of 3. Right? And so they show the 2 years prior, right, that we're using the sum of the year's digits. But then we switch, all right, we switch to the straight line rate. We also made some adjustments, right? Was it 5 years? Yeah, it was 5. Okay, so that was the only change that they made. All right, so it stays 5 and it still stays 3 million residual value. Okay. But really, all we have to do, all right, is recalculate, all right, what the book value, all right, on depreciable costs is book. Okay. And then apply, all right, the changes moving forward. Okay. Take note, all right. The residual value stays the same. However, we're going to take this portion. Okay, we did it for 2 years, right? 2 of the 5, and so we still have 3 years remaining. Okay, and so we just divide by the 3, right? And now we have straight line depreciation for 16, 17, and 18, the 3 subsequent periods of $8 or 8 million, whatever it is. And so the adjusting entry, right, that we're just going to make at the end of the period, right, is only for 2016, and we just use the number that we just got done calculating. So changes in depreciation method for newly acquired asset for Rome and Haas. So this is just giving you an example of that. The change in a reporting entity. All right, so it's kind of, we started off with a change in accounting principle, from one generally accepted accounting principle to another. That was retroactive. Then we went to change in estimate. That was prospective. Right? And then we also talked about the change in accounting principles that are treated as prospective. And now we're back to the retroactive stuff. Right? And so a change from reporting as one type of an entity to another type, okay, occurs as a result of consolidated financial statements, all right, the changing of specific companies that constitutes a group for which consolidated or combined statements were prepared, okay, and changes in accounting rules. And so a lot of what you guys are going to, not a lot, but something that you guys are going to do in advanced accounting, right, is you're going to deal with reporting consolidated financial statements. All right, so if you can think again, you have a parent company and you have a subsidiary. Normally, that subsidiary and parent company are buying and selling product between each other. And that's a lot of times why one company will buy out the other. Right, so maybe it's their supplier or whatever. If you think about it, for the subsidiary, when they make a sale to the parent, they're going to record an accounts receivable, sales, right, and then reduce their cost of goods sold, right? So that's what they would be journalizing when they sell something to the parent. The parent is going to record that inventory at their purchase price, right, or their cost, the parent company's cost. But when you consolidate those, you basically have to wipe out all those intercompany transactions, right? Because, if we're reporting sales for both companies, we can't include the sales that were done between, the parent and the subsidiary. Okay. And so, when we change those entities, right, we have to treat it as if we either never had that entity or we've always had that entity. So change from reporting as one type of entity to another type, okay, as I said, could occur, right, because we're now consolidating where maybe we didn't consolidate in a previous time. So we only have owned 47% last year, but this year because we bought more stock in the stock market, now we own 52%, right? Well, we now have to consolidate, right? That's the mandate when you own more than 50%. So reported by recasting all previous periods, right? As if, okay, the new reporting entity existed, right, all the time, or, on all the previous years presented. Definitely a disclosure note should be describing the nature and the change and the reason for it. And so here, change in reporting entity, Hartford Life, okay, and they just, added or subtracted different subsidiaries, okay, and the ramifications. Again, all right, they show the increase in stockholders' equity, right? So they not only describe the change, they show the financial effects of that. And that takes us to error correction, okay, which is where I plan to stop for today. Right? So, unless you guys just want me to push on through, what time do we have? We got a whole nother hour. You guys want to just finish it up?
I don't care. Whatever.
All right, let's do it then. All right. This really isn't that difficult either. All right. Error correction. Okay, when you think of an error, it could be because we journalized something wrong, or we didn't even make a journal entry. All right, whatever it is. Okay. We have to do retroactive restatement. We got to fix those things. All right. And so, when we find the error, okay, in the current year, okay, if that error was made in that current year, okay, then we just fix it. All right. But if we find out that we made an error in a previous year, even in some situations that self-correct, we need to disclose or report, okay, in the financial statements with the proper information. Right? And so, caused by a transaction being recorded incorrectly or not recorded at all, previous year's financial statements are retroactively restated, right? And so that's true with all errors. Well, I should say, depending on when you find it. So, these errors, or I guess this is this was part A, and this is B. Okay, as far as the way that the textbook's set up, all right? And so when we have errors, okay, we're going to have retroactive restatement, okay? We're going to restate all the years that are presented, okay? If we have to, we're going to have to make an adjustment entry. But what's kind of nice, all right, is that, most of those adjusting entries are going to hit the retained earnings, right? Because anything that hits the income statement is closed at the end of that period, right? And so it's already included in the retained earnings. So we're gonna journalize by hitting retained earnings. Okay. Journal entry to correct any balances that are incorrect as a result of the error, okay? And then definitely disclosure notes. And so steps to correct an error, okay? A journal entry is made to correct any account balances that are incorrect as a result of the error. Step 2, previous year's financial statements that were incorrect as a result of that error are retroactively restated. If retained earnings is one of the accounts incorrect as a result of the error, okay, the correction is reported as a prior period adjustment, the beginning balance in the statement of stockholders' equity or retained earnings. Okay. And a disclosure note is going to be included. Okay. And so here, all right, we have the statement of retained earnings for the years ended 2015 and 14. Okay. And 15 and 16. Oh. Okay. Oh, I guess they're just showing, right? The ramifications. So, we have the ending balance, okay, of 2015 here, okay, is being corrected, all right? So I should say not there, hang on. So let me erase that. Not this, what I should have highlighted, okay, was, okay. So here's our beginning balance of 15, okay? When we find that error in 16, okay, we start with the retained earnings statement. Last period's ending is this period's beginning, right? But then we do the correction, okay, and then the net income and dividends were the same if you go back and look, right? And so we now have a new retained earnings at the end of 15 that becomes the beginning retained earnings here. And then there were no errors that were disclosed during 2016. And so this portion is going to be the prior period adjustment. So we're going to credit we're going to debit retained earnings, because remember, retained earnings, normal balance is credit. We're reducing our retained earnings by debiting it. So here's an error correction illustrated. Learn the process needed to analyze whether errors are encountered. It is significantly more complicated to deal with the error if it affected net income in the reporting period in which it occurred, and it is not discovered until a later period. And so here we have GH Little, right? They paid $3 million for the replacement of computers and recorded the expenditure as maintenance expense, right? And so, this was the journal entry that was done incorrectly. Or I shouldn't say no, this is the correcting of that error, right? So if we found this error, right, they had recorded this as maintenance expense, okay, and then cash, okay. And so if they found it in the current period, right, was discovered a week later, okay, before they close everything, then we just reverse it and we record the proper journal entry. By the way, all right, have you guys ever heard of WorldCom? WorldCom, was busted shortly after Enron, okay? But this was one of the common things that they were doing, all right? Well, actually, would not be. What they were doing is just the opposite of this, all right? They had maintenance expenses that they were recording like this, right, as if they were equipment. So what that did is that inflated their assets, which generally is a good thing. Say you have more, good in the fact of from an outside perspective, all right? More assets is better than less assets, right? But then it also had the ramifications of not recording this expense up here. Okay. They were recording this as if it was equipment when it should have been recorded as an expense. Right? And if you remember when we talked about this, both in intermediate and in principles, the difference between a capital expenditure and a revenue expenditure. A revenue expenditure hits the income statement, where a capital expenditure hits your assets. And so that is not this problem, right? This problem, they just did the opposite, right? They recorded an expense when they should have recorded the purchase of an asset. Okay? And so if we caught it in the current period, this is just the correction, right? So we first of all had to reverse it, okay? And then we journalize the correct one. Is there another way to do that? Yes, there is. All right. We could have, alternatively, okay, we could have done equipment maintenance. By doing this journal entry, okay, that would have reduced the expense and increased the equipment. All right. Either way, you could do it either way. So here again, Barnes & Noble's error correction note. You can read that. Error affecting a previous financial statement, but not a net income. All right. And so here, MDS, Transportation, incorrectly recorded a $2 million note receivable as accounts receivable. Okay? The error was discovered a year later. And so, all right, step one, okay, so they had a note receivable, okay, so they recorded it as an accounts receivable, right, for 2 million, and sales, okay, when this should have been a notes receivable. So to fix it, all right, all we have to do is reduce the accounts receivable and put it into the note. When a report from a comparative purpose, the current year's annual report, last year's balance sheet would be restated, right, to report the note as it should have been reported last period. Now, can you guys think of any secondary ramifications for this one or this one? This one? Like we did catch, this transaction in the current period, all right? But if we didn't catch this until the subsequent period, okay, we also would have forgotten or didn't depreciate that equipment, right? So that would be a secondary error because of the first error that we made. MDS, Transportation, incorrectly recorded a 2 million note receivable, all right? So yeah, step 3, last year's net income was not affected, all right? So you don't have to do any prior period adjustment to the retained earnings or the income statement. But you're definitely going to have a note disclosure. Pretty much all the time you're going to have a note disclosure, right? So yeah. Error affecting a prior year's income. Right? Most errors affect net income. When they do, they affect the balance sheet as well, right? Both statements need to be restated. The statement of cash flow sometimes is affected, right? So I don't think we're going to have any of those situations, but it can be. Okay. Incorrect account balances need to be corrected, right? Income tax often are affected by income errors, okay? And so amended tax returns are prepared either to pay the additional tax or to claim a refund. And so here's an example. In 2006, internal auditors discovered that Seidman Distribution, right, had debited an expense account for the $7 million cost of sporting equipment purchased at the beginning of 2014. Right? The equipment's useful life was expected to be 5 years with no residual value. Straight line depreciation was used by Seidman. And so, all right, this is the correct or what should have been recorded, right? They should have recorded as equipment, right? At the end of 2014, we're going to have the depreciation expense, right, and accumulated depreciation, and then again in 2015. What happened, all right, was because they expensed it all in 2014, not a very good job of matching, all right? The depreciation ones were, omitted, okay, to a total of $2.8 million. Total expenses were overstated, right, in 2014, right, because of that difference. And so to correct things, right, we first of all need to put that equipment on our books, right? And so we're going to journalize equipment. Okay. The expenses, right? Okay, these expenses, these expense, and so they're basically saying, hey, we overexpensed in this year, and then we didn't expense enough in 14 and 15. It's currently 2016 when we found the error. Okay, and so the net impact, the 7 over here and the 2.8 million here. Okay, we have an overstatement here of the 4.2 million, and so that's what this represents. Right? Because expenses are closed, right, to retained earnings, right? Our retained earnings was understated a total amount of 4.2. And then the difference is going to be put into the accumulated depreciation. Step 2, the 2014 and 15 financial statements were incorrect. Okay? As a result of the errors, okay, we need to retroactively report them as if the error never happened. And so step 3, okay, they're again showing the changes, all right, that would have impacted, beginning retained earnings, right, from 2015 and 16. And we wouldn't need to do any adjustment for 2014 because it didn't occur until after the beginning of 2014. And then step 4, obviously, note disclosure, right? Communicating the ramifications here, right? And then also the earnings per share. So a fair error affecting net income, okay? Recording of an asset as an expense. Okay. The effect of most errors is different, depends on when the error is discovered. If the error in our illustration is not discovered until 2019, that piece of equipment would be fully depreciated, right? And so there really wouldn't be any difference between the accumulated retained earnings, right? And so no correcting entry at all would be needed, right? Because that asset would be fully depreciated. Most errors eventually self-correct, but even if they self-corrected and we are still presenting one of the years that the error is disclosed, we need to fix it. We need to reinstate it. And so they're just showing the 2-year impact of over or understating ending inventory. All right. And so in 2016, all right, 2 years later, after we made a mistake, right, where we understated ending inventory. Okay. If you remember, the impact of understating ending inventory results in an overstatement of cost of goods sold and an understatement of all other things. Okay. And so, because this just flows down to here. And so if you understate ending inventory, you overstate cost of goods sold. If you take your revenues, subtracted the overstatement of cost of goods sold, right, that leads to an understatement of gross profit, understatement of net income, and an understatement of retained earnings. Well, one period's ending becomes the next period's beginning, right? And so if our ending inventory is understated, our beginning inventory is understated, which will end up having the effect of understating cost of goods sold, right, which would then understate our cost of goods sold, which would have an impact of overstating gross profit. Gross profit leads to an overstatement of net income, which would lead to an overstatement of retained earnings for 2015 that will counter effect, all right, the retained earnings from the previous period. Okay. And so it self-corrects over the 2-year time period. And so, okay, if in early 2016, all right, they discovered that $1 million of inventory had been inadvertently excluded, right, therefore understating from 2014. Okay. And so this is before closing of 2016, all right? Or I should say, if the error is discovered in 2015, right, what we need to do is we need to increase the inventory, okay? And because everything has flowed down to retained earnings, we're going to need to increase our retained earnings also. If the error is discovered later, okay, then there is no correcting entry. However, we are still going to have to reinstate, right, or restate all the financial statements that are presented. Okay. So 2015 statements are still retroactively restated. And so, step 3, just showing you, the beginning retained earnings balance leads to the prior period adjustment, and the overseas statements of that's the name of the company. I was like, that doesn't make sense. Overseas statement of share of stockholders' equity. Okay, disclosure note. All right, we're gonna, again, explain why we changed last year's numbers. Here's an example where we failed to record sales revenues. In 2016, General Paper Company discovered that 3,000 of merchandise sales in the last week of 2015 were not recorded until the first week of 2016. The merchandise sold was appropriately excluded from 2015. Right? And so we need to record, all right, this sales. Okay, it should have been recorded, in 2015, increasing your accounts receivable and sales revenue. Okay, and then there would have been no journal entry because we recorded it in the proper time period. However, it was recorded in 2016, and it should not have been. So, again, we discover this. When did we discover it? Okay, it was not recorded. Merchandise sold was appropriately excluded. All right, so, yeah. So to fix this, all right, in 2016, all right, what we're going to do, because this would have been closed to retained earnings. Okay. That's why we're using the retained earnings here. All right. We're recording the sales revenue, or we're taking the sales revenue out of 2016, and we're putting it back into the retained earnings. Again, 2015 statements, all right, would be restated, okay, retroactively. Okay. Step 3, because retained earnings is one of the accounts incorrect as a result of the error, the correction to that account is reported as a prior period adjustment to the beginning of 2015's retained earnings in General Paper's comparative statements. And then we definitely have our note disclosure. And here is a huge note disclosure, restatement of previous issued financial statements, okay, and explaining why they had to go about doing that. International financial reporting standards, right? Companies move for the first time from US GAAP to IFRS. So this would be a change in an accounting principle, right? Because IFRS is allowable in the U.S. now, right? And so IFRS number 1, the first time adoption of international standards of reporting, the basic requirement, full retroactive application of IFRS for the company's first IFRS financial statement. So again, what we're talking about, if we made the change, right, in 2020, we would retroactively restate 19 and 18's financial statements, right, as if we were always using IFRS. However, if you had last year's 2019's financial statements, 2019 would be completely different, right, than the 2019 that is disclosed in 2020's financial statements. First, IFRS financial statements must include at least 3 years balance sheet and 2 of each of the other financial statements. First time application, recording some assets and liabilities not permitted under US GAAP, not recording or derecognizing some assets and liabilities, reclassifying items that are classified differently under the 2 sets of standards, providing disclosure in the notes to the financial statements required under IFRS, provide extensive disclosure to explain how the transition to IFRS affected the company's financial position, financial performance, and cash flows, and providing explanations of material adjustments to the balance sheet, income statement, and cash flow statement. Reconciliation of the equity and total comprehensive income reported under previous GAAP to under IFRS. There is Optional exemptions and 5 mandatory exemptions to the requirement for retroactive application. It's designed to allow companies to avoid excessive costs or difficulties expected for retroactive application of certain standards. So again, this is for international purposes only. Optional exemptions are related to business combinations, fair value or revaluation as deemed cost for property, plant, and equipment, and other assets, employee benefits, cumulative transaction differences, compound financial instruments, assets and liabilities of subsidiaries. And then all these other ones, you can read all those. All right, so basically they're saying, hey, there's exceptions when you change to IFRS for the first time. And a lot of these things are quite complicated, all right? And so the need to do retroactive may not apply in these situations. So the differences, all right, accounting changes and error corrections. We learned US GAAP, so when correcting errors in previous issued financial statement, it's considered practical to report retroactively, right? When correcting errors in previous issued financial statements, right, they permit the effect of the error to be reported in the current period. 5 exceptions cover areas in which retroactive application of IFRS is considered inappropriate, related to the de-recognition of financial assets and financial liabilities, because it's mandatory. Hedge accounting, mandatory. Non-controlling interest, mandatory. Full cost oil and gas assets, that one's optional. And then determine whether the arrangement contains a lease, right? If it does, it's mandatory. Almost all adjustments arising from the first time application of IFRS are against opening retained earnings of the first period as presented on IFRS. And that's the end of chapter 20. Let me stop the recording.